So while we wait, maybe Peter, we can talk a little bit about how you expect to have the chat with Cathie. I know you have a number of questions for Cathie, but what are you most excited about this chat this afternoon?
Well, I'm excited because thematic investing and being looking far into the future actually happened in the investment community back in the late 1990s, but it disappeared after the dot-com burst, and we got to talk much more in equities about value factors and momentum factors in the emerging markets as a new phenomenon. And then I would say ARK Invest and Cathie have really put back thematic investing and looking far into the future back into the investment community. And I think it's actually shaping a lot of ideas and ways of looking at equities. You and I often also talk about, I mean, valuation on equities. And it seems like there have been a paramount shift in the way equity investors look at some companies. They discount with a higher conviction than ever, a positive future. And definitely some of the technology vectors that Cathie is sort of representing here, I find very interesting, and you also know, Steen, because you basically told us to go in that direction. We have to talk about the big, broad mega trends and themes that shape the world. So we're doing some of the same things as Cathie, but we're doing it on an inspirational level, where she's really putting money on the table, so to speak. And I think it's a very inspiring story. Also because I think ultimately investors, we talked about it over lunch, right? And people want to hear a positive message, basically.
Yeah, no, very much, and I think that is really one of the one of the jobs that Cathie and the team has done best is to define there is a future and a sort of a travel away from this giving up on the future, and secondly that using the network effect as the price mechanism to some extent. At least that's how I see it from my chair, being a trader and a portfolio manager. That it seems like this concept of the future value of a company is the amount of the square root on the amount of users. Of course, being an old geezer who comes from a bottom-up macro perspective, I would also like to make a little bit of money in terms of reoccurring revenue stream. But how do you see that fight between the square root of users relatively to the fundamental lesson that we were taught in business school? Oh, I think we've been joined by Cathie. Can you hear us, Cathie?
Hallelujah. I
Perfect.
apologize. Oh,
You have
goodness.
nothing to apologize for. I mean, getting up at 7 o'clock, standing by is amazing, Cathie. So no apologies needed. We have just been buying a little bit of time, and if you didn't listen in, we have been praising you, among other things, for being a trailblazer in terms of performance. But for an old geezer like me, at least with over 30 years experience, similar to you, I think what you really do is that you put a positive spin to a world which is increasingly meeting a lot of obstacles and limitations in terms of how we think about the world. And I'm not even talking about politics here, Cathie. I'm just talking about the fact that the world. So maybe if you wouldn't mind, just go into it. I gave an introduction. I talked about your trailblazing performance. You've been giving a lot of credit up front. Don't worry, you get more during the interview. But to setting the scene, and I think it's pretty fair to the viewers and listeners right now to make them aware that your fund is not as a concept built to be the same as the capital weighted index. I know you talk about that extensively every time you go on TV, because I think it is important. I mean, me as a portfolio manager, not that matters, but I see your fund as something I have for 5 to 10% for the alpha, for the potential to be the upside scale, the exponential value of something. Maybe you want to address that up front, because I think that sets the scene really well for what we're going to delve into afterwards.
Okay, yes. Well, the way in the early days, in order to help people understand what we were doing, we used to say, look, you may not believe in our forecast, our exponential growth trajectories, all of which are a function of extensive modeling. But if we're right, your benchmark sensitive portfolio or benchmark aware portfolio is going to be populated increasingly by value traps, stocks that are cheap for a reason. But if we're right, many are going to be disrupted or disintermediated by the most profound changes that have been technologically enabled in the history of the world. And many people will say, okay, that sounds like hyperbole. It is not hyperbole. I founded ARC in 2014 because I saw a dearth of research and investing in innovation in the public equity markets. And I saw that the tech and telecom bust and the 08-09 meltdown had put extreme fear into our business. And so hugging benchmarks became the safe way to go. We think that that will not be the safe way to go during the next 5 to 10 years. And just to frame this up for you, in 2019, truly transformative innovation was the market cap of truly transformative innovation was roughly $9 trillion globally. I mean, $7 trillion. So it was less than 10% of the total public equity market cap. If we are correct, that number during the next 10 years, and this is a revision, it will go to $220 trillion. And in the process of all of this disruptive innovation will be creative destruction. That is the other side of disruptive innovation, the disintermediation, the disruption of the traditional world order. We've never had 5 innovation platforms evolving at the same time. The closest we can come to this in history has been in the early 1900s, telephone, electricity, and automobile. And those did transform the world. They cut across economic sectors, and they were launching pads for more innovation. The same thing is true of DNA sequencing, robotics, including adaptive and collaborative robotics, energy storage, artificial intelligence, and blockchain technology. And not only is each of these 5 platforms scaling exponentially now, the time is now, but they are converging. And the kinds of explosive growth that we believe are going to come out of this convergence can be characterized by autonomous taxi networks. Autonomous taxi networks will be the convergence of 3 of these major innovation platforms: robotics, autonomous vehicles are robots, energy storage, they will be electric, and artificial intelligence. They will be powered by artificial intelligence. This opportunity alone, we believe, will deliver revenues in 10 years of roughly $10 trillion globally. Now, the numbers I gave you before were market caps. This is actual revenues, 10 trillion according to our estimates versus 0 now. And that's the next 10 years. So our lives are going to transform in a way that we can't even comprehend now. But what ARC is trying to do is educate not only investors, but parents and grandparents to steer their children and grandchildren to the right side of change, stay away from the creative destruction, and move into disruptive innovation. So I hope that's a good setup.
It was very eloquent. I can tell you've done it a few times before, Cathie, in terms of explaining the strategy. And it's, as a trader, I mean, really what you're saying is that you buy optionality tickets, you buy small deltas of a lot of things, not trying to predict which one will work, but it sits inside these mega trends. And I think that is important for the clients. I know you've often been quoted by saying that people more, when you're interview, want to talk about the risk than the upside. But I have to start I mean, you will forgive me for wanting to start on this energy crisis that seems to be emerging. And just, I understand fully that you will, of course, argue in a minute that the compounding effect of all you just said will outpace the short-term effect on the energy crisis. But how do you see your model? How do you see the stocks over the next 0 to 24 months in what we have deemed to be the paradigm we think we are in is that the physical world has simply reached its limit due to underinvestment, but also due to the fact that technology and otherwise, we are not capable of extending this elasticity. You and I grew up with, when we switched on the light, there was electricity. That is, right now around the world, not the fact. That's talk in the UK having a 3-day work week. Clearly this, at a bare minimum, slows down some of the process you talk about, or does it?
It actually accelerates it because innovation solves problems. And we had a very good example of that in the COVID crisis. I remember I did a YouTube video weekly because we had a point of view, and my background is economics as well as finance. And our point of view at the time was, look, the world is going through a shock. It's a shock to our system. And the COVID crisis has created a lot of problems. Innovation solves problems. Technologically enabled innovation, better, cheaper, faster, more productive, more creative, especially solves problems. And so, if anything, the energy crisis is going to accelerate the shift towards electric vehicles. That is already happening. Just today, we got numbers from China, and the new energy vehicle segment, this is a September number for China, was up 202%, whereas total sales were down 13% on a year-over-year basis, total auto sales. And, oh, by the way, Tesla sales in China were up 51%. So there is an accelerated shift towards electric vehicles. Now, to address your supply concerns, I agree with you completely. What we're seeing now is severe underinvestment in many industries. Energy, probably the most important. And one of the reasons is because of the ESG mandates of pension funds and foundations. They have been influencing large energy-related companies to shift their investment away from traditional fossil fuels toward the new energy, the renewables in particular. And so we're seeing a dearth of capital spending in the oil industry now, much like, and now I've been made fun of for saying this, but you have to go back to the whale oil crisis to see a similar phenomenon. At one point, whale oil was the source of our energy, used to light up our homes. But as we were discovering fossil fuels, the investment in whale oil collapsed. So what happened to whale oil prices? During that collapse, they were very volatile, both on the upside and the downside, as the shift towards fossil fuels began to take hold. But the resolution of that volatility was to the downside. And so we're seeing energy prices, oil prices in particular, that are much higher than we thought they were going to go. Not because of the demand side, it is because of the supply side. In fact, we do believe that the demand for oil, and this still holds true, peaked in 2019. I believe it was, I won't get these numbers exactly right, but something like 104 million barrels per day. And I think we're back up to, we got to roughly 90 during the crisis. And then this year, we're up to roughly 97. Now, forecasts are that we will go out to a new high in 2022. But if we're right, maybe we'll skirt with a new high. I doubt it, because what we're beginning to see is the impact of some of these price increases on demand. Consumers are pulling back, and they can pull back. Unlike in the 70s, when we went through the quadrupling of oil prices because of the OPEC cartel, we had no choice. We had to drive to work. And I remember I had just gotten my driver's license in California. I was, 4 cars deep around a block to wait for gasoline. Today we can stay home, and we've gotten a lot of practice during the last 18 months. And so I think we're going to see a reaction, a demand reaction to these price increases. The other thing that we're going on, since we're speaking of, that we believe is going on, since we're speaking about risks, is many people, I think, look at auto dealer lots. Here in the United States, there's very little inventory on the lots, just 17 days of inventory. Normal is around 60 days. And many are saying to me, you're completely wrong about what's going to happen to the auto sector here, because what we believe is during the COVID crisis, in order to avoid mass transit, a lot of people bought new and used cars. We had a 60% increase in used car prices. And where are those cars now? They're not on dealer lots. They're in our garages or our driveways, our parking lots, and they represent excess inventory. We probably wouldn't have bought that extra car, certainly not here in the United States, if it weren't for the coronavirus. And this is true of a lot of goods. We spent a disproportionate amount on goods because we could order them online, not on services. In the United States, goods account for only a third of consumption, but they went well north of 40% last year. What does that tell us? Well, we have a lot of excess inventory stored in our homes, whether it's toilet tissue or Clorox, and we're seeing the fallout from that now. Many of these companies are reporting decline in sales. So I think there's a lot of confusion, a lot of chaos, but we do believe that the impact of price increases will not be to feed through and cause a wage price spiral. We think instead, technologically enabled innovation is going to accelerate, productivity is going to accelerate, and to the extent wages are going up because of labor shortages, many people don't want to go back to work because they're fearful, then productivity gains will do a lot to offset those wage gains.
All right, now that we have talked a little bit about the risks, Cathie, we also want to talk about the future, your bold vision for the future. And can you take us through what the world will look like in 30 years from now through your lens with the different technology vectors that you have invested in? I mean, what would the world be like in 30 years? Is it 100% renewable energy, autonomous vehicles? We have individual medicine. I mean, take us through what the world will look like in 30 years.
Sure. And I'll start out by saying the seeds for what is happening now were planted during the 20 years that ended in the tech and telecom bubble. Back then, too much capital chased too few ideas too soon. What do I mean by that? Too soon meant the technologies were not ready and the costs were not low enough. And just to illustrate one idea there or example, DNA sequencing, which is going to transform healthcare completely. DNA sequencing, the first whole human genome sequenced was in 2003. It took $2.7 billion and 13 years of computing power to sequence the first whole human genome. Even if costs had collapsed 75% the next year, we were not ready for prime time. Today, we're down to $500 per whole human genome in a few hours of computing power. So we are at the threshold of each of us getting our own geneticist or having our doctors consult with geneticists. And for the first time in history, we can identify mutations in our genomes. So there are 6 billion bits of code in our genomes, 3 billion base pairs of DNA. So and this is the double helix. So 6 billion bits of code. Until now, it was either too expensive or not possible to identify one mutation, which is a programming error in those 6 billion bits of code. Now we can isolate a mutation. Why is that important? Mutations are the earliest manifestation of disease, and so all they are programming errors. Now, on top of being able to identify them, there are therapies already in place that will help address some of them, not all of them. In fact, not many of them. We're learning so much that the therapies will follow. But one of the most important therapies is CRISPR gene editing and other gene therapies. With gene editing and base editing and prime editing, we believe that we will be able not only to reprogram our genome and to correct the programming error, but we will also be able, thanks to the convergence of DNA sequencing, artificial intelligence, and CRISPR gene editing, we will be able to discover when our bodies are setting up to move into a disease state, when they're setting up to move into stage 1 cancer. We'll be able to catch cancer before stage 1. And we believe we will, with time, and this is going to take a lot of time, be able to reprogram our genomes and cure the disease. So that probably will, to get to that state of perfection, will take 20 to 30 years. But we do believe that the next 10 years are going to bring such hope. Already we've seen with immunotherapies, training our own bodies to fight cancer, to identify cancer and then fight it. That's causing miracle cures in cancer. We're going to see a lot more miracle cures because of this convergence of DNA sequencing, artificial intelligence, and gene therapies. So healthcare as we know it is going to transform completely. Now, the pushback we will get on that is, oh my goodness, here in the United States, we spend nearly 20% of our GDP on healthcare, double the rest of the world. And so the question we'll get is, this is going to be a real problem for us in terms of the cost continuing to explode. That is not true. What is going to happen in healthcare is this, and I'm not making light of this, is the same thing that happened to advertising. Before Google and Facebook and Twitter and other social media, advertisers used to say, I know that half of my advertising works. I just don't know which half. That's even more true in healthcare. The guesswork that has taken place in healthcare over the last, and this was doctors and scientists doing the best they could with the knowledge they had. But the guesswork, we believe, certainly here in the United States, given how litigious our society is, has caused more surgeries than necessary, and probably, in the case of thyroid cancer, for example, probably twice the number, more than twice the number of thyroid cancer surgeries than were necessary. Same with chemotherapy. I remember in the early days of Genomic Health, a company that helped doctors discover which of their patients with breast cancer would benefit from chemotherapy. And roughly half did not benefit from chemotherapy. All it did was hurt them. All it did was harm them. It took a long time for doctors to believe that this test was true and that they wouldn't be sued for a false negative. And so, it's taken time for these new tools and new therapies to move into the system. But now there's a belief that, hey, this is going to change healthcare. This is going to cause cures, and this could cut costs as we eliminate unnecessary expenses. Our biggest liability as a country here in the United States is the medical retirement liability. We believe that liability, as we're actually curing disease and identifying disease and and targeting our therapies more appropriately and more specifically, more precisely, our medical retirement liabilities are actually going to go down. And I feature
Cathie,
healthcare first. Yes,
if I didn't know
I was.
better, no, no, it's fine. It's if I don't know any better, I would say you're on a crusade here, and it seems like this. I can see the light in your eyes, and this is something that really talks to you, and I think you did really well in explaining why you're doing what you do and what you're trying to achieve. So I think we're absolutely with you on that. But we want to explore a few other things with you as well, Kathy. And one is, of course, with the highlight that's always on you, when you started to sell China, it became a big issue, not only in U.S. press, but certainly in Asia as well. And we have a question here from our friends in the investment community called West Money, good colleagues of us. They're asking, what are your views on China tech stock with the recent regulatory crackdowns by the Chinese government? And let me extend the question saying they're really asking you, how do you see the Chinese valuation? Do you see a future for Chinese technology platform and stocks? And how do they compare in one question?
Yes, well, we started pulling out after Jack Ma was effectively banished for something he said to a legislative committee focused on the financial services sector. Now, I read what he said, and to me, I'm sure I missed something culturally because I didn't see anything insulting, but they were terribly insulted, and he is effectively gone, or now he's doing charitable good works. That was a red flag for us, but we didn't know how much of a red flag until we started seeing the heavy hand in terms of regulation on gaming and social networks. And yesterday I saw that the government is now investigating regulators, financial regulators, and how they have regulated the financial system. And they're going after financial systems and their regulators. So there is a real, if I can say, it's a bit of a purge going on right now. Quite anti-capitalist, I would say. But there are still ways to invest. And we have cut down in our flagship portfolio. You'll see no Chinese stocks because our flagship portfolio is our highest conviction names. But in our autonomous technology and robotics portfolio, we do own a few names that have a few characteristics. One, very low gross margins. Profitability, the government does not consider profitability consistent with common prosperity, which is the new buzz phrase there. So JD Logistics, JD.com, Pinduoduo, names like that have very low margins, and they are serving common prosperity by moving into tier 3, tier 4 cities and bringing logistics and online shopping opportunities to people who have not had them before. So they are consistent. We have kept a toehold in Tencent despite the gaming regulations, because we do know that the Chinese government wants the digital yuan to be the reserve currency of Asia. And really only Tencent can help the Chinese government proliferate the digital yuan in the way it wants. But other than that, we have cut our exposures significantly.
So what I hear you saying is that you still think there's opportunity, and I think you're on the record for saying as long as it's government-sanctioned assets, and that but right now it seems we have too much noise in the talk of the market for going on. I think Peter has a follow-up question, which it goes to some of that, but in the U.S., Peter.
Yes, because I mean the regulation that is going on in China, we've talked a lot in our team whether that could suddenly come to Europe or even the U.S. I mean, regulating the number of hours kids are gaming, because it is, you can talk about engagement or you can call it addiction. It's probably the same thing maybe. But we were talking about to what extent that will come to the U.S. But also you saw the front page, I guess, on with Mark Zuckerberg on Time Magazine. And to what extent do you think platforms will be regulated? Facebook, are we seeing the seeds of an regulation coming to the U.S.?
Well, I don't think. I think there's a chance more in Europe. Your regulatory regime it tends to come after companies even in the U.S. before the U.S. regulatory regimes do. So I think there may be some of that in Europe. In the U.S., my sense is there will not be that much at the margin everywhere. Yes. Um, I do have a little bit of a differentiated view on gaming, and it's born of my own experience in not in gaming. I'm not a gamer, but I'm watching I'm watching employees come into ARC, and they are. If you've ever looked at our team page, they're very young, and what I've noticed is I can tell the difference in terms of strategic vision and understanding, decisiveness, and critical thought processes. I can tell the difference between gamers and non-gamers. So if anyone were to bring me in front of Congress to be an advocate for gaming, I would be. I think it's part of our new age, and I raised my children in Montessori schools, and we were told not to let our children game. But I saw something different. My son was the gamer, not my daughters. And I saw how his thought process developed much more quickly than my girls did in terms of this idea of strategic decision making and decisiveness. So that's a little bit on my soapbox. The lessons from Microsoft, at least here in the United States, trying to break up Microsoft, tells me this is going to last 10 years. We're going to see a lot of deliberation about it, a lot of tweaks at the margin. I don't think we'll be breaking up our companies at all. And I do think when there is a problem out there, technology can take care of it. So if you think about blockchain technology, that is going to be the kiss of death for the data aggregators that have grown up on the internet, the Amazons, the Googles, the Facebooks. And if Gen Z gets up in arms with the lack of privacy, I don't see it in millennials, but maybe Gen Z will go there. Then these platforms are going to lose a lot of their power. Let the market take care of it. And just another example here in the United States, the AT&T, the monopoly telephone system, was broken up into 8 baby bells. What happened over the next 30 years? Because technology was changing the world of telecommunications, those companies started faltering, and they had to consolidate again. So all that for nothing.
All right, thanks. We have to talk, of course, about electrical vehicles, and your bet in that technology vector, of course, is Tesla. And there's a lot of debate about Tesla. Have the bar been raised in terms of being a car manufacturer? There's certainly a lot of new car manufacturers out there, and there's some great numbers from Credit Suisse that since 1950 there hasn't been a U.S. company with a starting point of $6 billion of revenue that grew for 50% annualized for 10 years, as Elon Musk says that he believes Tesla can do. So the question to you is, do you think that Tesla is this one outlier that will defy all the previous numbers we have on U.S. companies in terms of the growth opportunities? Is it that big?
We do believe it is that big. So if you look at the revenue growth the last 5 years, it's compounded at roughly 48% per year. And that was, as you recall, when Tesla was experiencing quite a bit of controversy. Our forecast for the next 10 years is in the 50 to 60% range. Depends if you take our bull or our bear case. And there are a few reasons. There are 4 barriers to entry that seem to have gotten higher in Tesla's favor. The first is battery technology. So Tesla is the only car manufacturer, with the exception of just a couple in China, the only car manufacturer that decided to ride down the cost curve of the consumer electronics industry using batteries that we find in our laptops, our cell phones. And when Tesla decided to do that, auto manufacturers actually laughed at it, as did auto analysts, because there were advertised or publicized battery blowups on airplanes, and so there was a banning of that kind of battery. So because of that, its costs are so much lower today. The cost of its battery or its battery pack system is so much lower than other auto manufacturers that if they really want to compete with Tesla, they're going to have to lose money in electric vehicles while their gas-powered vehicle sales are falling. That the alternative will be less power or less range. So we're seeing a lot of permutations around that. So battery, still 3 to 4 years ahead in terms of cost declines of other auto manufacturers who decided to use lithium-ion pouch technology as opposed to the cylindrical batteries that Tesla uses. The second barrier to entry, and this I think is the critical one from a valuation and a growth point of view. Tesla is the only auto manufacturer to have designed its own chip. Tesla is taking a leaf from Apple's book. If you remember in the day, Apple was the upstart. Nokia, Motorola, and Ericsson were the winners in the cell phone space. Apple was this upstart that had the point of view, Steve Jobs, that this was not just a phone, it was going to become a computer in our pockets. And he was right. And I'll never forget the delight I felt when I was able to access the internet on my phone. I just thought this was revolutionary. The others didn't follow. They didn't have their own chip. They didn't have the vision. And today, even today, when Apple's market share has gone down to 12%, it takes most of the profits out of the global smartphone market. And then the other two barriers to entry. So the artificial intelligence chip, why is that important? This is all about autonomous travel. And it's the only one doing this. And we believe that the other barrier to entry they have is the billions upon billions upon billions of miles of real world driving data that Tesla has accumulated, so that with its AI expertise, Andrej Karpathy is the expert in autonomous transportation. They now have more corner cases to train their systems on than any other company. It's not going to be possible for these companies to catch up because Tesla already has more than a million robots, including my Model 3, roaming around, collecting data and sending it back every day. And then the other barrier to entry, which I'm surprised this one still exists, is over-the-air software updates. I got my Model 3 in 2018, and I've never had to take it in for a problem. Tesla apparently has diagnosed any problems I've had and corrected them before I see them or experience them. The only problem I've had is a nail in a tire. And of course, software could not correct that. But that was it. And so those four barriers to entry have given Tesla the lead. Our base case is $3,000 in 5 years from $800 today. And our confidence in that has grown because what we're seeing now is Tesla able to scale EV manufacturing in a way that no one else, except perhaps BYD in China, no one else is doing this yet. And Tesla had to go through a huge learning curve to get there. This is not like the manufacturing of traditional autos. It's a completely different game. And so we believe that Tesla's market share, we used to say we thought Tesla would take 25% of the electric vehicle market in 5 years. Now we're saying we believe Tesla will take 25% of the total vehicle market in 5 years. And we think electric will be nearly half of total vehicles sold.
Cathie, talking about targets, I know I'm almost embarrassed to ask this question, but you also, of course, I need to ask you about Bitcoin. I think everyone under the age of 40, which unfortunately I'm not, but anyone under the age of 40 will come after me if I don't ask you if you still are that bullish, and I'll let you define yourself how bullish you are on it. And maybe for me, the old boy here, to talk a little about the network effect that you think, I presume it's driving this effect.
Sure. We gained our first exposure to Bitcoin in 2015 when it was a $6 billion network. Today, it's about $1 trillion network in a $2 trillion new asset class. And that what I just said is very important, new asset class, because institutions have to look at Bitcoin. The correlation of returns here is very, very low relative to any other asset base. The highest correlation between Bitcoin and other assets is real estate, and that's a 0.3. That's the highest. If you look at most others, very low correlations. This is what institutional investors are seeking. We had a bit of a pullback this year after Elon Musk put Bitcoin on Tesla's balance sheet, Square as well, MicroStrategy as well. And the pullback was all about environmental. Is Bitcoin going to, is it consuming too much energy? Is it going to create too many bad environmental impacts? And so we had the setback from 64,000 to about 30,000. Now we're closing in on 60,000 again. And I think partly because of our work with Square, we held a conference called The B Word, and it was all about the misconceptions around Bitcoin in particular. And environmental is one of them. I remember the same argument being made about the internet in the 90s and early 2000s, that the consumption of electricity was outrageous. It was that of a major country. I forget which one they were using at the time. And of course, we can see how the internet has transformed our lives and increased access to the emerging markets through this little thing called the mobile phone, the computer, and transform lives in such a good way. You can say there are side effects there, but I think everyone agrees that the internet has been a good thing. Bitcoin is the first private global rules-based monetary system that the world has ever known. And we believe that El Salvador, what's happening in El Salvador is unbelievable. Today, because the president decided that El Salvador was going to step out and innovate, the president there has given every one of his citizens $30 worth of Bitcoin in a Chivo wallet. Now, if you look at that country, only 1.2 million out of 4 million adults have banking accounts. Already today, roughly 3 million have downloaded the Chivo wallet and are using it not just to get access to that $30, but to do peer-to-peer exchange. So when you talk about the network effect, we think remittances will be one of the most important, and I believe we have numbers on that remittances account for a disproportionate amount of the activity. We believe emerging markets are going to embrace Bitcoin, get away from many of them have corrupt regimes, and they don't trust their monetary authorities. They don't trust their politicians generally. And so we think emerging markets are a huge use case here. And we believe that use case alone, if we take away the 4 major money supplies that probably aren't going to change that much, that use case alone will add, I believe the number is 200,000 if it were adopted fully throughout the emerging markets ex-China. That would account for $100 to $200,000. And forgive me, I don't know which one it is. I do know if institutions were to allocate 5% of their portfolios globally, ex-China, that use case alone would be $500,000 in addition to the $60,000 in Bitcoin's price. This is much like what happened with pension funds when it came to real estate in the 70s. It came to emerging markets in the 80s and 90s into the 2000s. We think this is the next iteration. This is the diversification into a completely new asset class, the first truly new asset class since the 1600s when equities launched.
Cathie, we are only down to 2 questions. We have 90 more questions for you. But I want to take the opportunity. I saw on your Twitter handle that you call yourself a women's advocate. By the way, I love the word advocate. You're not an activist, you're an advocate. I think a lot of women sees you as a beacon in the financial industry. You are one of the ones that got away with being extremely successful. How do you see your own role? And you know, it may sound a quirky question, but how serious do you take that role as a women's advocate and someone who sits very, very much on the top of a beautiful product in itself?
Thank you. Thank you so much, Steen, for that question. I take it very seriously. I take it very seriously for all young people, especially. I think it's our industry, which will be disrupted, by the way, so get on the right side of change. But our industry is one where performance can be measured every day. Now, do I look at performance every day? Of course I do, but do I take it to heart every day? No, we have a 5-year investment time horizon. But that idea of the financial world, the world is our oyster. We get to study how the world is going to work and invest in it and really play a part in making the world a better place. It is a wonderful career. And if anyone, but especially a woman, can get into a position where her performance is measured, for better or worse. I've had my bad years and good years, but you know, they average out over time. If you can get into a position like that but be a part of a team, because I think that the world is going to go much more collaborative as these technologies converge. So that this idea of being part of a team that excels in performance and being a really good team mate and always seeking the truth, not letting politics get in the way, encouraging collaboration, encouraging teamwork. I think that's the route to success. And if we're right on how much success is ready for the taking out there, if you devote your career, you work really hard, head down, politics aside, make these incredible numbers for your clients first, and then your team second. It's an incredible career. Now you have to have a thick skin, and you have to just keep your eye on pursuing the truth, because a lot of, if you see on Twitter, there are a lot of haters. You just can't let that get in the way. Just move forward, do the right thing, and don't get distracted by the noise out there, because all of that other stuff is just noise. And I realize in certain companies, your performance will not be recognized. Your boss, even though you're making him look amazing, and that's your first priority, by the way, make your boss look amazing, like he's the most brilliant person who ever walked the earth. And if he or she does not reward that by giving you an opportunity to grow, move on and find the person who will do that.
I will remember that, Steen. But Cathie, a final question from my side. We saw the fire in your eye when you talked about genomics. I find it as a very exciting technology. I think MIT have coined this century, the century of biology. and I really much believe in that. But is it also your biggest conviction in terms of all the disruptive technologies that you're looking at, or do you have something next side genomics that you think is probably even bigger? Or
so genomics, we believe still today is the most underappreciated, is going to create the biggest surprises out there, because we're so early. The autonomous taxi platform opportunity in transportation, we think that will happen more dramatically and sooner, because regulators actually do want to save lives. And because 80 to 90% of all accidents and fatalities in cars are caused by human error, we're seeing our regulators becoming much more friendly to Tesla and to autonomous travel generally, because their scorecard is saving lives. And with texting, deaths have gone up, especially with young people. So the regulators are going to enable autonomous transportation to scale faster than we think the regulatory approvals will take place for a lot of the genetic related medicine, the genomics medicine. Nonetheless, the genomics opportunity will be bigger longer term.
Cathie, it's been an absolute pleasure. And I'll say on my behalf, and I'm sure that it goes through the whole audience, if they're not inspired after these almost 50 minutes with you, they cannot be inspired at all. So thank you for the bottom of our heart. You are very eloquent. You are very committed. I think the best attribute I can give you is that you can see in your eyes how much you love your job, how much you're working with this theme. And for me, that goes all the way from somewhere in the US to Copenhagen this afternoon. And so on behalf of Saxo, on behalf of everyone watching, thank you very much for reaching out, and continue to be that beacon for women in finance. Trust me, we need more of you in this industry, and good luck to you and the team going forward. I understand you are changing the landscape from my old city of New York to Florida. I cannot understand that move, being a half New Yorker, but good luck with that as well, Cathie, and best of wishes for the rest of the year.
Thank you very much, Steen. Thank you, Peter, as well. I've enjoyed this enormously, and I just love the innovative spirit that I find in Europe, Denmark, especially. I'm always impressed, and just love speaking to this kind of an audience, because I know we're all going to make this happen together.
We are indeed. Yeah. Thank you for those words, and thank you for everybody for tuning in. And best of luck to everyone. And do follow Cathie online everywhere. It's an amazing team she put together, as she said. And I'm pretty sure her whole team makes it look very good, right?
Yes, my team. My secret weapons. Those young people that you see on our team page, secret weapons. They aspire to transform the world and make it a better place, and they are brilliant.
Thank you.
Thank you.
Thank you.